Peter, welcome back, Peter. How are you, buddy?
I'm good.
Okay, so I don't think you've been here since we had Zoom. There's a share.
No, I was. I was
you
there
were?
the last time.
Okay.
Yeah, it's much better than, but I still don't know how to use Zoom properly.
All right, well, there's a drop-down menu
Yeah.
where you just hover your mouse and you'll see a green box that says share.
Okay, so I'm just going to share screen.
Right.
Peter, are you of Greek origins?
Am I what?
Campbell.
No, actually, that's not really my name. I'm half Italian.
Okay, sorry. No, I was looking at another Peter in the chat box, which has a Greek last name. Yeah. Campbell is definitely not Greek. Okay.
You know what
And,
they call? You know what they call someone who's half Jewish and half Italian, Peter?
No, I don't.
Jewop, jewop.
Well,
I've never heard that one, huh? Oh, anyway,
no,
that's the music.
I probably not allowed to tell that joke. But
All right, anyway, I can do anything. This is my show. I'm like the Howard Stern of FX, okay? So, anyway, buddy, go ahead.
The other part of me is English and French, so.
Okay. All right, well, you know, before we get started, Peter, I want to acknowledge the last time we were on, there was a lot of negativity, and your euphoria tool that you used was calling for much higher prices and a blow-off type of move in the S&Ps, and that's exactly what happened. Nice call.
Yeah, well.
How now, brown
the funny
cow?
thing is actually I have a discussion which I would like to have here with you guys all about emotion. I had a talk with a good friend of mine yesterday. Come on, load this damn image. It's I'm sorry, this should be loading a high resolution image. I'm just going to go to the Twitter feed.
Okay.
I think it's here, and
we were able. So I was able to see it. Okay.
Yeah, but that's clear.
All right.
Basically, I use a totally different process for analyzing markets than most people, basically, I want to discuss this a little bit because I think it's really, really important to understand that markets operate like relationships. And I had a discussion with a good friend of mine yesterday about this and gave him the blow-by-blow process of how markets change their mind and how they change their mind when it's sustainable and how they change their mind when it's not sustainable. And we're in one of those situations right now. And the top was also one in which we were in one of those situations in which I should have been fully shorted at 39 or 38, 33, 38.
Okay.
Yeah, 33, 38. No, I didn't really actually want to be completely short at around 80 because you know, there still seemed to me that there was, and if the market had not received exogenous news, it would have been, you know, we would have gone higher and finished the.
Well, I mean, 33 is close enough for government work. I'm sure a lot of people wish they would have seen it there.
Yeah, well, that's the discussion I'm going to have with you guys now, and because it implies with the same conditions with this low, and I really want to sort of get into it. Right now, we have a chart of the Globex Sentiment Index that I posted earlier today. A little bullish excess energy here at this low, which may very well, since other charts have completed some emotional activity, may be a decent bounce to 2620 or 2610, and then form a right shoulder with a slanted neckline. Those happen a lot in bear markets, and they're very nasty when they do. I don't like the normal head and shoulders patterns, but when you get a good slanted neckline, they can turn into something. So I always prefer to be aware of them than unaware of them. But back to the most important subject here, which is markets being like relationships. I would like everybody to consider something, which is that essentially when you have had a fundamental difference with somebody, and especially somebody you care about and you're interested in, and whose opinions matter to you. So you now have like someone, family member or wife or husband or whatever it is, girlfriend, boyfriend, and let's just give the example that I discussed with my friend yesterday, which was, let's say that you have children and one person thinks homeschooling, the other person doesn't think homeschooling. What ends up happening is that you have a nasty argument about this because the one person is very motivated about it and the other person thinks it's absolutely the worst thing ever. And that argument turns into festering other kind of stresses that might be in the relationship. So the argument becomes...
You mean like resentment?
What?
It turns into resentment.
Turns into, resentment. It turns into a large conflict. So I use this concept called an X-tick. An X-tick is very similar to one of these arguments. So I would like you to imagine in your life when
I don't have to imagine it.
Okay,
do you?
Well, that's good.
Most people have experienced it.
Yeah, and so whenever you have one of these very big fundamental differences with somebody you care about, or you need to care about, or you want to care about, resolving those differences doesn't happen in a single argument. Let me give you an example. So somebody's wife thinks that kids should be homeschooled, and her spouse doesn't think so, and they have some stresses in their relationship for other reasons probably. They have this big argument. Now, what's the chances that can be resolved in 15 minutes or a day even, where the husband comes back and says, "Oh, honey, you're completely right. Let's go on vacation. I'm really sorry about arguing with you." That would mean that his view would have to have totally changed without any real consideration for the fact that he held his view strongly before that homeschooling was not the right place for his children. So the way that he's going to change his mind, or the way that she's going to change her mind, is by having another couple arguments. And so the emotions of changing your mind and finally saying, "Yes, I'm sorry, I was wrong, I agree with you," takes a few emotionally charged arguments usually to get things straightened out. It's hard to change your mind about beliefs you hold strongly. And so the markets are very similar. When you get an X-tick in my world, that is an argument. It's an argument between buyers and sellers who hold their beliefs very strongly. And a single X-tick that holds prices, contains prices, is a very powerful event and suggests something about one person or another. I'm sorry, there's a little noise in the background because I'm on the balcony. I'm sorry. But if you have a X-tick, a buyer X-tick, where it holds prices back and then sends prices back down, then we have a clear winner to that argument. But what I'm interested in is when people's minds are changing. If the overall trend is down, then I'm interested in what happens at buy emotions that are charged in the buy direction. And so can we break out over those? And when you break out over a buyer X-tick, it's as if somebody started to recognize that they hold strong beliefs, but they might be wrong. And so then you have a second buyer X-tick, and then at a certain price, and then they say that breaks out. Now, the market as a consensus, if you look at it as a relationship, if you look at it as a person, has the same reaction. Now it breaks out, and you're starting to say, maybe I should think about this a little more seriously. After 3 or 4 of those kinds of confrontations, the market can sustainably change its mind. Now, why is this important in the market presently? The reason it's important in the market presently is that off these lows, to the tune of what is now about 400 points on the S&P, basically. We are dealing with a single X ticket, 2347, that broke out. And since then, all of the emotions that I look at are very contained. So they are not emotions that are symbolic of an argument. They're emotions of people trying to avoid making a decision, not confronting a decision, not being forced to face it. So what we need in order to make a bottom in a market is we need to get 3 or 4 X ticks that break out, and then you see that the people can sustainably change their mind, and they're willing to have commitment and conviction about that. Now this happened at the highs, and so we had, I remember it vividly because I count them. I have this rule that you have to have 3 X ticks at 3 X ticks regime changes in the market. 3 X ticks that break down, 3 X ticks that break out.
Why 3?
Because if you just look at the relationship you have with somebody you care about, it's the exact same thing. You don't resolve your differences in a single confrontation about them.
Yeah, but why not 4? Why not 2? Why 3?
Well, 2 is not enough. 3 is generally enough, but in a very, very, very strong emotion situation, you generally need more. So in a situation like this market, you might need 4. But, you know, the way it works is that...
Well, you know, I think 3 is a number of completion. That's why I was asking.
Yeah, yeah. Okay. And 3 is my company name. My intellectual property company is called M3 for a reason, because 3 is the most important number there is. And it was for me in music as well. As a composer, 3 was the constant relationship around.
Sexually, it was for me. Go ahead, buddy. Sorry. I couldn't help myself. Go ahead.
But anyway, so the point is right now we have, at the highs, we had a seller X tick at 33.65, 33.39, another one at 33.39, and one at 33.30. I had made the mistake on my piece of paper writing down those 3 prices, X tick prices, and there were 2 that occurred at 39, so I didn't really count them as 2 distinct emotional arguments. The pivotal price for me was underneath 33.30, at which point the regime in the market would change. And then if you recall, what was happening is that 33.30 should have been defended, and that could have become a decent rally, which would have retested the highs either as a higher low or a higher high. But once 33.30 was broken down, then that
someone had capitulated, and the argument was over.
The argument was over, and the regime would have changed. I'm quiet here. And basically, so what ended up happening there is that we ended up with a 120-point gap down underneath 33.30, and there the regime changed. And usually a regime change is pretty, you get tradable bounces in it, and this was one of the first ones where you didn't. And I suspect that when we get regime change off of a sustainable low, that it'll be similar. So I'm going to show you a chart in which I discuss that, and that's going to be on this next slide here. Let's see, where is it? Here. So I did a ball throw, gravity, and bounce energy dissipation within a broadening pattern example using a real-world kind of physics approach to things. So I created this chart showing a chart which I have been posting for a very long time. If anybody knows me, you know that I have been posting since the spring of last year, and probably before that, that it was my impression that we would see a throwover of the broadening pattern. Sorry about the messages there.
Which is what happened. Which is what happened up there. You know, you call it broadening. Some people call it a megaphone.
Yeah, a megaphone. Yeah. So my impression was that we would see a throwover that would be to 3,300, maybe to 3,500, 3,550, and then that would roll down. Now, what ended up happening is that this whole thing translated very, very, very far. And I actually thought it was impossible to complete that accelerated downtrend line in that time frame. But I don't, this is, the patterns are so strong. The only thing that was happening in this pattern, if you look at my charts that I posted, was that we were missing, and I don't know if you can see, no, I can't click, we were missing a wave in our real live market scenario. And that was that from 1 to 2 in our live market scenario, we didn't have a zigzag. So we were missing that wave, and that wave then became the throwover, which is why I thought that was going to happen. And then it still means that down here at wave 15 and 16, we should complete them at about the same time as what they would normally be in an ideal pattern. So what I think is a very likely scenario is that we get down, finish this pattern, and then all of the emotions in the market get tested very, very strongly. All of this liquidity and fake money being created, all of these stimulus programs by the government, basically bribing businesses with forgivable loans and all sorts of other tax incentives, et cetera. And the checks that are sent to people will ultimately be spent in the economy. Whether they are up to doing anything productive or not, I don't know. What I do think is that it's not, that we will see inflation from this, because the central banks always overdo it. And if anybody thinks that this whole virus situation, in my opinion, is the driver for this problem, I really think that that if you look back at how capitalism is supposed to work, capitalism is about capital. So what you're supposed to have is capital. What we have is called creditism. And so it's not capital, it's credit. And in the old days, many times there were wars that went on for 20 years or 5 years or whatever, and companies had to survive these things. So what did they do? They saved money. They couldn't go and
get bailed out,
bring in money from somewhere.
Yeah.
And there's companies all over Europe that are 500 years old that survived many wars. My point is that we are, what's happening is that we have an economic situation that's being created by a credit dysfunction in a way that is magnifying this whole process. And that's sort of, when you look at these broadening patterns, I want to remind you that this is a deleveraging pattern. So it is a pattern that exists when there's too much leverage, and it's a way of getting rid of that leverage. And these are not accidental patterns, in my opinion. This chart is a chart of the historical X-ticks that have occurred throughout history. Now, if the market had not moved basically 1,200 points in the matter of a few weeks, this chart wouldn't look cluttered at all. And in fact, what you can see is, if we zoom in here, the market goes between these X-tick levels, these emotional prices, very directly. Like, for example, if you look at this light here, I'm in the lower right-hand corner. If you look at this line at the bottom where the market bounced, that line has been there for years. So this is an emotional outburst.
Lost you. Is it me? Is it me, guys, or you? It's not me. You can hear me, right, Sinatra? Ryan? Peter is gone. Okay. What a great presentation. Okay. Let's see if he has anything on Twitter. She sent me a message.
I'm back.
Oh, good. Okay. Where'd you go? Bathroom break? Oh, no, it's all right.
Yeah, so I am sharing screen.
Okay.
Back.
I was just lamenting. So, Peter, you talked about it should happen at the same time. You have, so you must have a feel for, you know, you talked about it being an argument and, you know, the way we gap lower. Looks like it was a divorce. Okay, so that argument ended up in divorce. You know, arguments and you can reconcile, da 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 da. But that a gap to me said it was, you know, a pretty big argument. It was,
it was a very big argument.
Maybe the last one. So and then you were talking about it should happen around in the same time, around the same time. You have a kind of a feel for price and time. Do you have time zone?
Lucas timing is a very important part of my work. I don't, I tend to do things in zones. So, for example, I like to look at the markets and say, okay, where do I need to be extra alert? Where do I need to be extra concerned and aware of things that I might ordinarily not focus on? So, one of the problems that happens in bull markets and bear markets is that people are very focused in the direction that the market has been going on and extrapolate that forward.
Right.
I'm going to go to the Lucas timing chart in a second, but this essentially complies with the Lucas timing process here. I created this chart with respect to that. Basically, we're looking for a high. Essentially, it was around the 27th or Monday acceptable. Approximately, and then down into the next week into April. And what I see is, if you were following my post at mcmct.com, mcmct on Twitter, or on mcmct_markets, which is the new feed, then you'll know that when we came down here, I have been harping on this particular top of this emotional zone as a high probability that we would find support there. Now, I wasn't sure whether that support would end up being in the form of a 200 or 300 point bounce and then roll over, or whether it would be a higher one to support to test the previous resistance levels. But this is where this is a helpful process, because that there's a lot of committed emotion in these areas. And if you have an argument with somebody and you walk by the place you had that argument and it was a heated argument, you remember it. That place is changed. So it's the same in the market. When you have heated arguments in places, for market participants, those places change, and they change for a very long time. That's why I have this chart. And let's see, just to cover the other side of the argument, I would expect one way or the other that if we get down to our target range, which this cut off the prices on the right, I don't know why, this would be around 1850 to 1950, then we don't have to have a trampoline effect. The problem with our situation in the markets right now is that it's not certain that all this credit creation is actually going to do anything. Is it going to be effective? Is it going to go in the right places? And is there going to be so much inflation created that effectively it's not really stimulating anything? And in fact, we end up with stagflation. So depending on the strength of that stagflation is going to be potentially the psychology behind this bounce. And so we might see a bounce that follows the normal gravity without the trampoline. So if you look at this chart over here, what you see is that I have a trampoline. Trampoline is basically all of this insanity being created by the governments and central banks around the world, mind you, at a very delayed pace, because
it takes time. I mean, there's always a lag in monetary policy. People were talking about the market being vulnerable and the repo market having problems because the effects of QT from the year before had not worn off yet.
Yes, exactly. And
okay, so go ahead, buddy.
So this scenario would presume that all these monetary machinations are not very effective, in terms of that there's other things that happen that sort of counter them. And that would create a more gravity-oriented reaction to this next bounce, which would probably be up around the 3,000 area when it does happen. That would be a blistering rally if you consider that we end up probably in the 1900s to 2000 area. Right. But anyway, let's talk about Lucas timing. I'm going to go find that chart. This is going to take me a little bit here. Let's see, actually, I'm going to search for it.
What do you call those points again, Peter? You call them X points? What they call
X-ticks.
X-ticks. Okay. Got it.
That's weird. It doesn't search in my private channel. Okay, but here it is. Anyway, this is another interesting point. Lucas timing to me is extremely powerful because it's subjective. And it doesn't mean that the market can't accelerate out of Lucas timing, but the point about that is that if you look down the bottom here, we have these little yellow dots. Those are the Lucas timing, and then we have subordinate yellow dots, which are a more minute Lucas timing, and then we have these vertical lines, which indicate where there is a predisposition for the market to do something. In terms of time. Now on this chart, I noted that this is a wall up here at around 2714 in terms of geometric resistance. The emotional resistance is slightly higher than that. It's a 2750 starts. And basically what you see here, interestingly, is that we had Lucas timing for a low over here. And what I discovered in my work, because there's two patterns that I watch: bearish and bullish running corrections. Those are the, I'm completely, you just don't want to screw those up. And if you're wrong, it's manageable. If it's something turns out not to be a bullish running correction or not to be a bearish running correction, it's still completely manageable. But if you decide to go long on a bearish running correction, it's a disaster. And that happened here in these markets. So we ended up with a situation where the market generated a very large bearish running correction around the 3150 area. So that started it, that began the running correction. It was confirmed at 3050. So, and I posted all those things and sadly posted that it was, that at the best likelihood it was going to turn into a 2800 test, but running corrections are often, essentially this running correction is about 170 points in size, 160 points in size. So it's very often that they achieve 300% of the measurement of the running correction. The other pattern that I watch very closely is the expanded flat, because I don't like Elliott wave, and I don't say that I disrespect Elliott wave people. There's some people who do it very well. I have respect for a few of them. Puff Dragon is one of them. There's also a couple others who are great. Jason Haver is another one who's great, and you can look him up. He does great work. But expanded flats are the death of Elliott wavers, and they also tend to kill, like running correction, they tend to kill indicators. So indicators get the wrong readings around expanded flats. And let me explain what this means. I got to go turn this off. I'm sorry. Where is this? It's driving me nuts.
What, people trying to get a hold of you?
Yeah.
Yeah. Okay.
So, there. Basically,
they want to have an argument.
Yeah, they do.
Go ahead.
You're perceptive. No, it's actually developers working on something, and they're messaging like crazy, so it's not gonna be going on like crazy. So going on for a while. Basically, the problem with expanded, what I found is that our 5 waves down, and just there's two things. C waves are much more powerful, or have the potential to be much more powerful than impulses in 3 wave. So I'm not a big Elliott wave person, but I'm just telling you my experiences, and my experiences are a little bit unorthodox because I tend to think that the market moves mostly in 3s. moves mostly as three waves, and it moves mostly in ABCs where the C wave is composed of 5 waves. And this is the basic structure that I look for all over the place.
Okay.
So if you count the market move down from the highs, what you see is that we have achieved 5 waves into this Lucas timing right here for what is looking like, to me, a C wave down that we are putting in, which is probably going to take us to the 1850 area.
Okay.
So on this first leg of this wave, we have 5 waves down, and the A wave in an expanded flat acts like people expect it does. What happens is that the B wave doesn't. The B wave should have been right here, like at this red line, and given people a higher low, and then given people this C up here where people could balance out their positions. What screws people up is when the B wave actually drops below the low of A.
In irregular.
And then it's an irregular flat.
Yeah.
And that's what I think we have now. And
that's why people are stocking up on toilet paper, because of all the irregular formations here. You know,
Exactly.
Peter, I think I've done a pretty good stand-up routine, and you amazed me again today with this presentation. Really, your work is, you're like a mad scientist, my trading.
Yeah, I don't know about that, but
no, really, and you know, I have mentees that follow your stuff, so I've seen it. You're good.
Yeah.
How can people follow you? Is it strictly on Twitter, or do you have anything else going on?
Well, let me just finish this because we're almost done with this, and then we'll skip to that. Basically, this is the Lucas timing coming up right around April 7th, plus or minus a day.
Write it down.
The normal period, the normal activity for that could be a retest of the lows. It could be, in fact, that the market could extend higher. We could have acceleration from this timing right now. That's the 27th to 29th, which you can see at the bottom of your screen. That could turn into a point that's acceleration. I don't think that's happening. And I do think that we should see a low somewhere between 2150 and 1950 into the next timing.
Okay.
Or
and when is it? When's Easter? When's Easter, Peter?
Around my birthday. So
what is it? April what? What's the number on it?
I'm not sure. I think it's close to the 12th, though.
Okay, so the market's going to have a resurrection around Easter. So okay. What a great interview, buddy.
So anyway, if people want to follow
you.
Follow us, because it's a team here. I wrote all the stuff, code here, but we have a team. MCM Market Stream is private, and you have to actually subscribe to get that. And if you're not a member, then you'll see the subscription options on the page. Then MCMCT is, let me just get back there. MCMCT is the public stream. Now, I used to post completely on there for years all of the same stuff that I'm posting on MCMCT markets. The problem is it's distracting to deal with a bunch of idiots publicly, and it's a lot of work to do it. So the data that I make, I believe, is unique and very valuable. I'll show you just what we did
I'd like to know, while you're wrapping up, what's your view on this pandemic? How long you think it's going to go? Do you think this body blow to the economy is kind of fatal? So I'm wondering what your thoughts are.
Well, I don't. If you want my opinion on what I think is going to happen, I think we're going to get the trampoline effect here. That's my bias. I think we're going to go down into the 1850 to 1950 area and get the trampoline effect.
Because we'll be getting better news because the curve is flattening out. I mean, they are going to be related, aren't they?
Because the dream of Marxists everywhere, which central bankers are Marxists.
Okay, here we go. All right.
They're not anything to do with capitalism. Their whole goal
Right.
is to undermine capitalism, to
Right.
create crony capitalism that sustains this sort of ideal of, I'm going to show you this. This is my go-to post, which you guys should bookmark. Read that while I'm talking here. So this is what central bankers do.
Okay.
So one of the things that they are going to do to make sure that all the assets are on the bank balance sheets that people lose, and that they get people chasing wildly, as in the bottom of this, a process of wealth degenerating into a gamble and a lottery, in my opinion, means that we probably get the trampoline effect to get to a new high. But then the results of that are likely to be terrible, although I think it's possible that they might be able to save the system. These guys are unbelievable in their persistence.
Do you think they want to save the system? Or start a new one?
As long as they are increasing their power, yeah. And central bankers, in my opinion, are, they have a particular goal, and their goal is to consolidate the power of the banking system. Right. And to move power from the private capital into credit and banking.
They're mission accomplished.
Yeah. And so, so I think that if you ask me my opinion, I think that the way they probably end up doing this is by just hitting that Command P button as much as they can possibly hit to generate perception that furthers their longer term agenda, which is not capitalism. And so I'm emphatic about this. I post this all the time because central banking is about taking the power away from the people. If people wanted people to be powerful, they would give them capital. And capital stores your life energies. Capital stores the investments of all your learning. But the whole goal of our financial system the world over, and especially emanating from China, which is the de facto mechanism to implement the most extreme monetary policy ever, and express that in the world. And believe it or not, it's not being done by China directly. It's being done by other central banks who have given China the collateral to do it. So the PBOC really directly reports to the United States dollar. And you can say whatever you want, but that's how this works. And so all this crazy monetary policy in China and Japan are under the direct supervision of the Federal Reserve and the World Bank and the Bank of International Settlements. Yeah. None of these things are happening by accident.
Right.
So, and they're all designed to undermine capital.
Confiscate.
So that means, confiscate and to remove your ability to have a happy life without stress. Everybody will have
mission
stress.
Accomplished again.
Yeah.
Anyway, so, go ahead.
So anyway, you can follow me at MCM Markets, and you can follow me at MCM_CT, and then the website is mcm-ct.com. On a discussion of timing, I'm going to just go back to this chart. This is the idealized pattern, okay? Now, I don't know if we will continue to track this pattern, but I have to tell you, since I have not changed a line on this chart. I can go show you the posts I did last year, which all suggested that that a throwover would complete somewhere in December to February this year. And then when we started to get into February, it looked like they were even translating it further. But the end of this pattern comes in around May. So what it looks like to me is we'd probably get through the worst of this probably into April or May.
Okay.
Sometime.
All right.
And maybe early June. So, but I'd say May. If you asked me to put a number on it, I'd say middle of May.
Thank you so much, my trading warrior brother. Great presentation.
It's great to catch up with you. Okay.
Yeah, really. And so there's Peter. I'm telling you, you know, I want to bring the best people in, and here's an example of it. So
Well, Dale,
Peter,
you're a great person. I really appreciate knowing you and having you being part of our project as well. I think you use TIC tools, so you know what it does. So.
yeah, and thank you for your contribution and for all the help you give people, Peter. And really, my hope is that you and the people you care about, instead of having arguments, remain untouched by this virus. And you and I are brothers, so we can argue and still be brothers. We can argue about the
Exactly.
market and still be brothers, man.
100%. And I want to just comment to people who are doing well in the stock markets. Please consider the people who aren't doing so well right now and are probably having difficulty getting signed up for all the stuff that they need to help them. You know, if you can give them bigger tips or help people who are suffering right now, I think just the thought means more than the reality of whatever you do. So.
Okay, buddy.
Okay.
That's a good seed to sow for everyone. We all reap what we sow. So
Exactly.
that's a wrap, everyone. So don't just count your pips and your emotional X-ticks. Count your blessings. And I'll see everyone tomorrow. Adios.
Great.
Thank you, Peter.
Thank you.